Let me give you an example of how challenging this is, okay? With the U.S.-China relationship, obviously they're talking about specific tariffs, and we can, people can model those specific tariffs. But behind that, there is this broader discussion that's emerging about the relationship between the United States and China. And you're hearing more and more voices in the United States saying the U.S. needs to disengage, either partially or entirely. You have some people saying the U.S. just needs to cut commercial relations with China because it's no longer a partner, it's no longer a rival, it's a foe. It's an existential foe. And the more that you have that talk in the United States, the more you have a reaction in China. And then you're talking about how should markets react to a situation where the two largest economies in the world are really at each other's throats in a way that we have not seen them throughout the past couple of decades as the relationship develops. It raises questions of financial stability. It raises questions of other companies in other countries having to choose whether to do business with China or the United States and not both. Sure. So that's where I think markets really try to grapple with where is this heading. It's not just about an isolated set of trade disputes that can either be resolved at the G20 or not. It's more of a question of the trajectory of one of the most important relationships in the global economy.
No, absolutely. But as somebody who
and I wish I had a really easy answer about how to price that.
We're trying to figure out an answer too, Patrick. It's okay, you're not alone. But the point is that you raised the issue of the G20. The market is working with the assumption that something will come out of the G20. Given President Trump's latest comments on finding some common ground with President Xi Jinping. If nothing comes out of that major meeting, then what does it mean for the markets? Do the markets sell off? Do we revisit December lows? Or, Morgan Stanley was putting out a note saying the initial shock is out in the system, and so market psychology will adjust and absorb the news that they need to live with these trade tensions for a while.
I think we're going to see some volatility going forward because the news on any given day, Trump can tweet, great things happen at the G20 and the market goes up, and then people actually take a look at what was resolved, and then a week later we're talking about slapping some kind of restriction, not necessarily the tariffs, but some kind of restriction on a Chinese company and what the Chinese are going to do. So I think we're living from day to day in that sense, and that's why we need to go back to the fundamentals and look at how vulnerable is the U.S. economy, how vulnerable is the global economy to these kind of shocks. Because if it's just rattle the cages a little bit, that's one thing. If it's, look, if we get a bad jobs number tomorrow and we're really concerned about whether the U.S. economic momentum is continuing, that's the sort of thing that could push you over into the edge of a real slowdown.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.